Hims & Hers has recently published their earnings, which showed impressive growth metrics as well as ambitious guidance for 2030. When underlying the management's guidance, the company seems to be undervalued right now. But is this guidance and the resulting growth expectation reasonable? Q1 2025 earnings. The company achieved stunning growth rates, doubling or even quadrupling relevant metrics like revenue, net income, and cash flow. They also reaffirmed their 2025 guidance of $2.3 to $2.4 billion and even improved their margin expectation to approximately 13.5%. Hims management additionally gave guidance for 2030. They are planning with revenues of at least $6.5 billion and $1.3 billion in adjusted EBITDA, resulting in a margin of 20%. Despite the strong metrics, the stock experienced a decline of approximately 6% after the earnings were released. I'm personally no huge fan of such medium to long-term guidance, as this can be used very easily by the management to pump the stock. Nevertheless, this gives us a very good opportunity to evaluate the company, at least when the guidance is realistic. Valuation. From the revenue and EBITDA guidance of 2025 and 2030, we can calculate the following growth rates from 2025 to 2030. I assume the margin to improve by 1.5% yearly and the $6.5 billion revenue goal can be translated to a revenue compound annual growth rate of 22.6%, starting from the 2025 guidance of $2.35 billion. After 2030, I anticipated the margin to stay constant at 20% and the growth to half to 11.3% per year. For the cash flow conversion, I assume that Hims manages to convert 90% of the adjusted EBITDA to free cash flow. This is a bit lower than historical rates of 2023 and 2024, but still rather optimistic. With these assumptions, we get a fair value market cap of $15.1 billion, indicating that the company could currently be undervalued by a whopping 62%. If the profitability as well as the cash flow conversion stay the same as we predicted, Hims needs to achieve top-line growth rates of at least 16.2% per annum until 2032 to justify the current valuation. Should the profitability, cash conversion, as well as the revenue guidance for 2025 stay constant to the first DCF, the required growth to justify the current valuation is even lower to a very well achievable 10.4% per year. Is this all reasonable? Experts are currently predicting market growth rates for the global telehealth market ranging from 22.5 to 24.4%. This gives us an average expected growth rate of 23.3%, indicating that the company should be easily able to manage growth at the 16.2% needed to justify the current valuation. The guided growth rate of 22.6% until 2030 is also in line with this, further solidifying management's 2030 guidance and therefore our upside potential of up to 62%. Conclusion. Within our discounted cash flow analyses, we get a required growth rate of 16.2% to justify the current valuation. If we, however, assume that the company manages to hit their 2030 targets, Hims & Hers could even be undervalued by up to 62%. When considering the expected underlying market growth rate of Hims & Hers business of 23.3%, the company needs to only achieve approximately 70% of that to trade at fair value right now. That's why I'm currently rating Hims & Hers a buy. I initiated a small position that is currently up 30% already, and I will slowly build up this position through dollar cost average as long as we are trading below $55. What are your thoughts on the company? Do you use these prices to buy? Let me know in the comments below.